Okay, so why don't we go ahead and get started here with this market analysis. Okay, looking at the S&P 500 right here on a daily view, you know, the obvious pattern that I really see for this market right now is some kind of a triangle pattern. Okay, and triangles, what's usually a definition of a triangle? A triangle usually means that it's resting. It's some type of a consolidation pattern. Consolidation pattern, well, what does that mean? It just means that it's resting the current trend that the market is experiencing. And the current trend, or short-term or intermediate trend, is up right now. Okay, you can see that for the month of October, the market has basically shot straight up, not really giving a chance for it to breathe, for it to rest. And that's really what the market is doing right now. It's breathing, it's taking a breather, it's resting to really work out this extreme bullishness. Okay, the same thing happened back here, back in August, where the market just shot straight down, and it was extremely bearish, and it had to go through this period of choppiness to work out that extreme bearishness. And that's what markets do. Nothing goes straight up or straight down forever, so you can't expect this market to just continue higher without taking a break. It's the same analogy that I always use whenever you're running or hiking. You always want to take a little break in between, otherwise you'll overexhaust yourself. And same thing with the market. When the market makes an extreme move, it will need not only price correction, which is what it's doing, but also time correction. Okay, the market went up for a good month, so you kind of have to expect that it might rest for a good month or so too. Okay, but you just can't expect for it to rest a couple of days and then continue higher. Right? That's usually not how the market works. However long it took for it to go up, it might typically take the same amount of time, just like here, right? It took a good few weeks, and it took over a month for it to rest before it made another leg lower. So if we kind of use the same analogy to the downside and just flip it around to the upside, well, if we expect this market to just consolidate the current move, meaning that it's resting right now for the uptrend, what can we expect, or at least not expect, but more or less anticipate that after it's done consolidating, there's a good chance we might break out to another leg lower, just like how once it's done resting, it broke down to, break a leg higher, just like how here, once it's done resting, it broke a leg lower. Okay, so there is that correlation in the market where the consolidation pattern is kind of telling us that there's a good chance for one more leg up, and which kind of fits the whole theme and of the market, where usually towards the end of the year we tend to experience some kind of a rally. They call it the Santa Claus rally, and which more or less fits that pattern, because if, let's say, you know, November is going to be somewhat choppy because it's consolidating, so once November is more or less over, then that could mean we can rally into December, into end of the year, and whatever happens afterwards, quite honestly, is anyone's guess. You know, I don't want to think that far ahead. I just want to basically get through the end of this year. You know, this year has been rather difficult in trading. I mean, there's been periods of just extreme choppiness, extreme downtrends, more choppiness, high uptrends, and then more choppiness. So trading-wise, it isn't exactly the kindest to us traders. But you know, that's kind of how the market is in general. You have to realize that, you know, there will be times of just smooth sailing, right? Like here, you know, last couple of years, there will be times of extreme turbulence, okay, just like there and just like there. And so we're basically in a period where, back in middle of 2010, where it was extremely volatile and extremely, I guess, difficult. And you can kind of expect the same thing right now, where, you know, we're finishing the year kind of extremely volatile and extremely difficult in trading, okay? But just like everything else, this will pass, okay? This type of turbulence will eventually pass, and we will see a smoother trend. And when I say trend, I don't always necessarily mean an uptrend, okay? You can also see smooth trends towards the downside where things just kind of flow lower. But it will flow a lot faster than going up. Now, I switched to a weekly view here. What's interesting about this weekly view is that the overall pattern, you know, I kind of mentioned before, it kind of fit this 2007 pattern a little bit, where the market now is rallying back to retest this head and shoulders, and it basically did that, you know, but it did so in a lot faster manner than it did back here in 2008. So we'll see if it still continues to follow that pattern, okay? But I'll still continue to reference back here to give us a clue to see if this plays out more or less the same as it did back in 2008. But what's also interesting is that you can also tell there's a potential, okay? Of course, I always like to play out all these different patterns, all these different personalities or probabilities because, you always want to be prepared, okay, that there might be one big, massive head and shoulders that's forming on the weekly view right there, okay? So maybe this whole choppiness, this whole uncertainty could be working on some type of a right shoulder in the grand scheme of things, okay? This is a weekly view, so it's going to be a longer-term trend and longer-term pattern for this to work out. It might take another year or so for this right shoulder, maybe a few more months for this right shoulder to completely form. If that's even if it's going to be a right shoulder, okay. But at least I have this pattern, at least in the back of my mind, so I won't be surprised if the market does decide to form this head and shoulder and tank from that point on. And you can only imagine if this is truly a head and shoulders. Once it breaks this neckline, we can easily come down to this area, if not lower. Okay, and that's something. That's what I'm saying. At least that's something that I'm preparing myself for the upcoming, I guess, years to come. What do you see in this market, Chris? Anything you want to add here?
Sure. Looking at the daily view once again, we know that we had talked about the market being in a triangle, and something that also there's a potential for is also a head and shoulders pattern. And really, you just use the bottom of that triangle as the neckline.
You want me to go into an hourly view?
Sure, you can see that even more clear on the hourly view.
Yeah, I think sometimes the hourly view gives you a better clue as to the pattern sometimes.
So we have the left shoulder, the head, and the right shoulder. And we also we have that triangle that was formed too, with the top of that being slanted. And one thing that I'm taking a look at is this: if the market breaks above the top of that triangle, it's probably going to move back up and retest those highs around 1290 or so, which will most likely void that head and shoulders pattern. And it's just something that I'm keeping in mind. Also, if it breaks above the top of that triangle, then that consolidation period that we've experienced is probably done, and the market's ready to probably make a move up towards the end of the year. But there are a lot of people already talking about this potential head and shoulders pattern forming, and we really don't know that it's a head and shoulders pattern until the bottom of that neckline is actually broken to the downside. So that's something that I'm keeping in mind. If we go back to the weekly view, my goodness, we've talked about head and shoulders a lot this year, to be honest.
It's a very common pattern for some reason.
The recent head and shoulders pattern that the market was in earlier this year that broke with that neckline, the market came up and retested that neckline as resistance. So if we take what we had in the daily view and we saw that triangle, so the top of that triangle, let's say the market breaks above the top of that triangle, then most likely it's going to try to get above the neckline, and this neckline has already been retested as resistance, and if the market breaks above that, then we might see something a bit different than the 2008 pattern, where the market had rallied up and retested that neckline as resistance, and it failed from there and it continued to go down. But as of right now, this is just another plan that if the market does this, then we're going to do this. If the market breaks above the top of the triangle, then most likely it's going to break above that neckline and continue higher towards the end of the year. We got to always play out that scenario. And if the market breaks under the bottom of that triangle, there's also that head and shoulders pattern that was just drawn, and then that means the market has more downside to go. And that's really like how I like to play stocks or the market in consolidation modes, because you really want to come up with whatever potential scenario the market can have. So when it actually does something, then you already have a game plan already of knowing what to do. We know that if the market breaks above the top of this triangle, maybe and probably break above that neckline, then we're probably going to be leaning more towards the bullish side again. And if the bottom breaks if the bottom of that triangle, the neckline, that breaks, then we're going to be leaning more towards the bearish side or neutral side, and we won't really be taking a look at a lot of longs.
Yeah, so the market is really a good indication of what to do, and right now it's telling us to really do nothing because the market isn't really doing anything at all. I'm sure you guys read or see that we have 400 down days, 400 point down days, 300 point up days, and a lot of gaps. And that's really one of the more dangerous things when it comes to trading is these morning gaps are just horrible. I hate waking up in the morning and knowing that the market's gapped up 300 points or gapped down 300 points. It's just very, I don't know, it's disheartening, especially if you're holding positions and it's going against you. I much rather trade the market when it's not making these humongous gaps, but rather just kind of trade in a smooth, I guess, logical manner. And that's why when you trade in these type of conditions, it's really difficult in the sense that you're going to be making money, certainly, but also at the same time, you're going to be giving a lot of those gains back because of this whipsaw action. But something I just noticed also, if there could be a potential resistance downline here, connecting all the recent highs. If the market does break out, this could also act as a potential target for the next leg higher if the market breaks out, which brings us to around the 1300 level, and coincidentally, it falls more or less with this previous resistance area as well. And of course, that 1300 it always makes for a nice round even numbers, which the market likes to do. So some projections, some projected resistance right there for you guys to look at in the coming month or so. But overall, let me kind of jump into other indices just to see if everything else kind of correlates. And that's what I like to do, just kind of look at different indices to see, okay, which type of indices, which type of stocks are leading. And going into the Russell, you can definitely tell the small caps are the laggers here. They've always been lagging for the most part ever since the decline. And you can see it hardly ever came back to retest this neckline, whereas most of the other sectors have as well. So you can tell there's not a whole lot of speculating going on with traders out there, because they're basically moving more of their money into the bigger caps like the Dow or the S&P. And what's amazing about the Dow is that sometimes you kind of have to cycle through different indices, like I've mentioned, and the Dow just basically made a perfect retest or tag of this broken neckline right there. Okay. So even though we focus more on the S&P 500, sometimes when you look at the Dow Jones or the NASDAQ, they can give you some clean patterns as well. Okay. But lastly, let me look at the VIX. The VIX is the fear indicator, the fear measurement for this market. And what's interesting about the VIX is that it's honestly staying relatively pretty high up here. It's still up in the 30s. It's still up in the upper 20s. Which is telling us there's still some lingering fear that's going on in the market. Even though if you look at the market, it more or less recovered, I would say a good 60, almost 70%, right? If I were to draw this Fibonacci pattern, this is 62%. So I'm assuming we at least more or less recovered close to 60-something, maybe 70% at one point. But looking at the VIX, it's still relatively high. So again, there's still some lingering fear in this market that hasn't exactly subsided just yet, which kind of tells me or kind of shows that maybe this whole choppiness or rally could just be one big, I guess, bear market rally, okay? Because usually if this is a bull market rally, the VIX should drop into the low 20s and maybe eventually into the teens. But of course, that's going to take some time, and that's what I want to see, okay? Because back in 2009, that's kind of what happened, where it just kind of slowly drifted lower as the market went higher and higher. So if that's the same thing, I want to see that drifting lower back into this area, back into the 20s, like I said, or into the teens. And that tells us that the market is going up into a gradual uptrend. But right now, it seems like it's still holding steady, relatively high up into this area. So again, right, there's still some lingering fear that the market is going through, which means that the market is there's still some people who are hedging themselves with puts, and that's kind of what the VIX is kind of telling you, where the market is traders are tend to be buying a little more puts, meaning they're buying a little more protection for their positions. So, being the market that is choppy as it is, it doesn't mean that it's not tradable, okay? Even though we say, yeah, it's not the best environment to be trading, for people who are active, people who like to be in and out, this is where, being a short-term trader has its advantages. I mean, being a buy and hold type of trading is definitely not this environment. So if you are a trader, what I recommend is taking that trade and just basically either exiting the same day or maybe the next day. And that's really how we're taking these trades, just one day at a time, really. And a lot of the trades we've done, for example, let's kind of go over some of the trades we've done. Even though we had some good setups like here in GNC broke out, we don't take long targets like we used to before. Now we just go for like $1 or $2 targets because, like I said, the market is so choppy that it can easily turn around, and that $1 or $2 that you gained can easily be given back. So once we hit our target, the next thing that we like to do next is move your stop higher, because you never want to see your the profit give all the way back. And that's the thing. It's like in this environment, you want to protect your capital as much as possible, and you don't want to give any benefit of a doubt, because if things start turning around, it can turn around real fast. Okay, but we'll go over more about some of the trades we've done. But let's kind of go over the sectors, because I think there are still a few sectors out there that are looking really good. Okay, that still has some potential for some gains if the market does rally. What kind of sectors are you looking at, Chris?
First sector is XLU, the utilities. And this sector has really been strong for actually the whole year, compared relatively to the market. And we have a lot of buying coming in, and it does look like it's the safety sector for people to put their money in. It's also right under a resistance level, which is around $35.50 or so. If you really want to go into it, I mean, you can see a potential ascending triangle. Either way, we just know that there's some buying into the sector, and it hasn't been hit by selling compared to other sectors, and it's holding above its 20 and 50-day exponential moving average and trending nicely up. Some stocks in the sector that I really always just keep on my watch list, which seem like safety stocks, is SO. And that thing is trending, or I should say consolidating, right under resistance as well. So if I see XLU break above that resistance level we had just drawn, and I see SO break above that resistance level that it's under, then I'll probably be a bit more aggressive than conservative on the long side and play that breakout.
I just want to mention SO is something that we issued as a trade alert just not too long ago. Actually, I just reissued it back in because the setup is looking really good, and I think a lot of our traders, they like these type of setups where it's clean and where it's simple and it's easy looking. Okay, and these are the type of setups that we like to send out to our members because they're easily tradable. There's a defined entry point. There's a defined exit point. So there's really no difficulty in terms of how do you enter or how do you exit this type of trade.
Okay.
Go on, Chris. Yeah.
Next one is D. That also is a strong stock. And probably I'm looking for a move above Friday's high or so. The setup isn't as clean as the last stock we had just seen, but if I do see XLU breaking to the upside, and I see D getting above Friday's high or so, then that's also going to be another stock that I'm taking a look at from the long side. Another stock in the sector is DUK, Duke Energy. Very nice breakout yesterday. Volume wasn't too high, but we're looking at price action, and price action had that breakout. So that's really what I like to go upon. Volume is just usually the other factor to really tell me how aggressive to go. And there's another way you can look at it. You say, hey, there's a breakout. There wasn't a lot of high volume, and if you want to stay out of that, then that's fine. because SO looks a bit better. D looks okay too. Um, so you can play it that way. It's just another way to screen your watch list through the sectors and then trade what's comfortable to you and the way you like to be. Another sector that I'm also taking a look at is XLK, the technology sector. And that thing is actually looking pretty good to the upside as well. We have it's really coming up to a very nice resistance level that it couldn't get above for this whole year, around $26.80 or so. And if XLK continues to move up, then I would expect it to probably break above that level to help, especially if we get the year-end rally. Some stocks in the sectors like Google. Man, we had a bull put spread on Google. I remember that.
Yeah, we did. We had the 580, 570 bull put spread.
Right at that gap level. And you know, the reason why we did that is because Google had a nice clean breakout above 600. And then a couple days later, it actually faded back into 600, showing that it's probably a false breakout. And then yesterday, it had another gap up above 600. So if XLK wants to continue up to those prior highs resistance level that we showed, then I wouldn't be surprised for Google to continue its move as well and probably retest that prior high of around 630. Another stock in XLK is IBM. And IBM has felt like it's a type of safety stock too, kind of similar to SO or D. There's a nice clean cut resistance level, also a type of ascending triangle, and it's around 187.50 cents or so. And if this IBM gets above there, then most likely we're going to see it gets about 191, somewhere around there, and move up to the upside. Now, there's certain types of ways that you could trade IBM. An aggressive approach would be to wait for the top of that ascending triangle to break, and then go lightly in some longs, and then ride it up to about 190 or 191 or so, and then you can take some profits or something like that, or you can continue adding on that breakout above that 190 level. Now that's more of an aggressive trader's approach. Now if you're conservative, safety, something like that, then you probably want to see IBM move up, and in between that red diagonal lines June has drawn, you probably want to see a move up and then consolidate in there first, and then make that break of 191 to go long. That's a more conservative approach. Either way, both approaches are fine. It just depends on what type of trader you are and what type of confidence you have in this market, in this stock. June, is there anything you wanted to look at?
Yeah, I do. There's actually a few. I want to also mention some of the retailers that are actually doing really well. And these retailers aren't exactly like your high-end retailers. What I'm talking about is stuff like Walmart, which seems to be moving up relatively well. Earnings is approaching next week, I think Tuesday. So that's something to watch out for. Same thing with Dollar Tree. Okay, it's still basing, still holding above its 50-day moving average, and earnings is approaching. So a lot of these stocks maybe are waiting for earnings to get that pop. Dollar Tree does make huge gaps. Okay, so watch out for that if you are holding the stock. Same with Ross Stores. Again, earnings is approaching, but it seems to be basing, and it seems to be moving up really well. So a lot of these smaller retailers, I guess lower end retailers, are doing well as auto stores like AutoZone. You can see how it had a very nice breakout from here. This actually fits into one of our setups, a volatility squeeze setup, where it broke above this. Basically, it was in a contraction mode, okay, and now it expanded into expansion mode. But however, there's really no volume behind this breakout, so I'm not too confident about this particular breakout. And then the other one's O'Reilly, which more or less the same thing as AutoZone. Again, like moving higher. See how after earnings it popped up, moved higher from that point on. So a lot of these lower end retailers seems to be doing well, and again, right, those could be clues to let you know that, hey, maybe people are going to be spending less on the bigger brands like Nordstrom or whatever the case is, and going for these lower end retails uh, for economic reasons. Okay, so people are pricing that factor in by going into these stocks where it's going up and higher. The other thing I want to mention is gold. I'm sure a lot of people are interested in gold. Gold is looking not too bad. I always talk about the weekly view of gold, where you see how it's always holding this 20-week moving average. Now, it did kind of stall around here for a little bit longer, but nonetheless, it still held this 20-week moving average, and it seems to be moving up above it. So it continues to display that same personality of holding above this 20-week. Now, if it decides to actually come back down and crashes, I wouldn't say crash, but completely close and gets under and comes back to the 50-week or lower, then the personality of gold has changed. Okay, kind of like here. Once it broke, then it's due for a deeper kind of pullback. But right now, the trend for gold still looks good for the time being. Let me kind of go back in. And I would like for it to kind of base a little more. It got into a pretty overbought territories right there. But nonetheless, it's still showing some good higher highs, higher lows. Made a nice pullback. So if it can consolidate a little more and break out above, I think this is the 175 for GLD, then we can most definitely see higher highs for gold. And what's interesting is that a lot of these gold mining stocks are also doing really well, like NEM, which made a nice high up here. Let's see if it can base a little more. AUY, not as strong, okay, but still moving up. The other one is gold itself. I like this one a lot more. You see how it broke above this previous resistance, and now it's holding this as new support. Okay, very basic, very I guess you can say fundamental technical analysis right here, where it broke above resistance. Now it uses that resistance as new support. Okay, so if it stays above this area, maybe base a little more, right? And then that's a good sign. This is a good place to get into. And then let me give you guys one more, RGLD. Okay, same type of deal, and you notice it's not as strong as the previous one, but nonetheless, it's still looking really well underneath this previous resistance. So again, a lot of these gold mining stocks and gold itself is looking pretty good compared to silver, which is still down in the dumps right here. And that's why I said before, if I were to choose between this or gold, I would much rather prefer playing gold, because gold is at least gaining more grounds as opposed to silver. Now, even though, yes, it is a quote-unquote cheaper stock, you don't want to just buy based on cheaper stock. You want to buy because there's a potential for profit, for potential for growth. And right now, I don't see that same thing happening to silver as compared to gold right here. So those two, and then let me just kind of talk about, like I mentioned, some of the trades we've done so far, just to keep you guys up to speed as what we're doing. Right now, we're not really holding a lot. I mean, the only long position that we have is McDonald's, which we've held since $90 right here. And that's what I mean. You want to hold these stocks that just continues to outperform the market, and it's staying above its 20-day moving average right there. We did enter some shorts into Apple. And Apple, I've mentioned in previous meetups, it was showing signs of a top, and it looks like it's starting to break down. This is an island top, by the way, if you've never seen one. And it broke down on Thursday off of this base, this nice little base right here, on some pretty decent volume. Okay, so hopefully Apple does what it's supposed to do from a technical standpoint and come back towards this previous support area of around 355 or so. So this one we're holding shorts. We're also holding shorts on Win. It didn't exactly perform as well as we thought, but nonetheless we're in it because it's underperforming the market. So if you notice how we're choosing our stocks, we go long on stocks that are outperforming the market, and go short on stocks that are underperforming the market. Even though the market isn't really doing a whole lot, there will be stocks that will kind of do its own thing. Okay, there will be stocks that would just kind of basically move on its own, independent of the market, if enough buying pressure or if enough selling pressure is there for that stock. Okay, so there are still trades out there, but overall in general, what the market is telling you is if you do trade, go very lightly. Okay, never, never, ever, especially in this market condition, put too much into one position. Some stocks that we're actually looking at for this coming week or so. What's interesting is that some of these stocks are setting up kind of nicely. I noticed there's quite a few good setups going on out there, which kind of has this bullish tendency. Okay, whenever the market is consolidating and you see stocks that are consolidating as well, that could be a potentially good sign. At least if you're bullish, it could be a good sign because these stocks are basing and getting ready to move once the market does move. For example, SCSS, after this huge breakout on earnings, it's forming some kind of a nice triangle, some kind of a base. So, and volume picked up a little bit more on Friday. So I think if it breaks out from here, then this could be a good stock to go into. V, which is something that we traded before. This was a volatility squeeze trade. We might actually consider going back into this stock, and it looks like it might need to get above 96 before doing so. But you can see that Visa is doing really well as in terms of this type of setup. Another one we're looking at for next week is TSCO. Okay, and I'm sure you guys are starting to notice a similar pattern where things are, again, right, forming some kind of a triangle or some kind of a base. But notice how this is a different type of triangle. It's ascending, whereas the market is kind of in a symmetrical triangle. So that means these stocks are experiencing a little more buying pressure coming into them because of the inherent strength that's going on with these particular stocks right there. Let me give you guys a few more here. SIMO, okay, another strong stock that really outperformed the market, but you can see it needs some time to rest because, well, it had a huge run up, and now it seems like it's forming some kind of a triangle right there. So again, I don't expect this thing to just continue higher, but it needs time to rest after an extended period of run, right? Just like the market, it needs time to rest. But once it's done resting, it looks like it's a pretty good stock to get into for this particular trade here. You know what? Let's kind of open up to some questions. I know some of you are dying to ask questions, or if you have certain stocks that you guys are looking at, we can kind of look at the stocks, or again, if you have questions about the market or about certain topics, feel free to ask those questions. While we're waiting for questions, what I'd like to talk about is also that certain earnings, now that earnings is over, there's certain stocks, and one thing I want to talk about is that was a comment that was made about buying on an earnings gap up. And I think it's doable, as long as there's a valid setup, you can definitely buy on an earnings gap up. A lot of people tend to think that a gap up, if a stock gaps up like 5% right from the get-go, that it's too far from let's say a safety point to buy. And sometimes that is true, but if it's a strong setup, if there's a valid setup, and if the stock gaps up, I think it makes for a valid buy. For example, we bought here on STMP, even though it gapped up a buck, which is what, a good 2-3%. What I liked about it is, even though it did gap up, it gapped up from a base, right? So to me, that was a valid buy. It's as if, okay, let's say, if there was no earnings and this stock broke above it, that made for a valid entry, right? That made for a valid place to buy above this breakout there. And when it did break out, right, even though it did gap up, it still made for a valid buy because that that volume is going to come into the stock. So when you buy on these gap ups, I would tend to buy if there is for example, if there's a base setup and it gaps up above the base, I would buy basically right at the morning, and I would kind of see where the bottom of the gap is. So the bottom of this gap is what, like around 26. So that basically leaves me about $1 risk. If it does, let's say, have a false gap up, then at least I'm out for $1 loss, okay? But at least it's worth it because I know a lot of these gap ups tend to run up for a good few dollars, like here, this one. And same with SIMO, right? Here on earnings, it had a nice gap up, and it ran for at least a couple of bucks. And this was a nice valid setup because it made a nice pullback towards the 20-day. And as soon as it gapped up, it continued higher. from that point on. All right, someone asked about how about selling after earnings gap up, say, price line? See, what's different about price line and the other gap up I talked about is it didn't gap up above resistance, right? It gapped up within this whole range here. So I wouldn't be too confident about buying or selling this gap up because it tends to, well, it doesn't really show a whole lot. So it needs to clear a certain resistance before I decide to buy. Now, selling after a gap up, it doesn't always work out because you see stocks that gap up and continue to run, like this one here, where it gapped up after earnings, right? And it just continued to run. So it's really hard to say that all earning gap ups will fade. But what's interesting about this one, see how it gapped up above this resistance, right? Above the certain resistance. So that made for a good valid gap up to buy on. But price line, I can see why it kind of faded because it didn't gap up above this resistance here. Okay, so it's not a buyable gap up. I don't think that's a buyable gap up. Same with Chipotle here, right? Even though it had a nice gap up, it faded afterwards because, well, it didn't gap up above that resistance. Okay, so there's a difference when it comes to gap ups on earnings that I like to buy and certain gap ups that I like to stay away from. Okay, so if it can gap up above it, then sure, then that makes for a good valid stock to buy. And the opposite is true. We look at something like GMCR where it was a steady, back here when the stock is moving very up nicely. See how when it does gap up on earnings, it gaps up and continues to run. But what's interesting is that the trend really tells what the stock is going to do. When it was trending up, like here, when it was trending up, earnings tend to be good, right? And it always gapped up on earnings. But now that you see there's a change in trend, the first time it had its earnings in a downtrend, well, guess what? It gapped down. Okay, so you can tell from the trend the same thing with Netflix, where when it was up, right? When it was trending up, for the most part, the gaps were up, right, on earnings. But now that it's in a downtrend, you can see once it changed trend, the gaps are now going down. Okay, so the trend can kind of help you in terms of if you want to predict or play earnings. They can kind of help you. I don't want to say predict, but I'm going to use the word predict in which direction the earnings is going to gap. But it's got to be a nice established trend in order for that to do so. If it's going to be kind of choppy, like right now how Google is kind of choppy, you're going to get a lot of up and down gaps where it's kind of hard to predict as far as where it's going to go. But speaking of Google, I think Google looks pretty good even from a weekly point of view. Right there, it seems to be forming some nice base right there for Google. And right, if Google continues higher, then it could break out from this base. Long-term wise, it could be good, but of course, that all varies, and it's very dependent on market conditions as far as what Google can do. But this is a potentially good stock for the long term if it can break out of that base, and of course, if market plays well. For the time being. But one of the things I want to talk about is when it comes to earnings, I think it's worth a shot, especially with these high-flying gap ups. If you look at options, okay, options like weekly options, something that's out of the money, like what I noticed was something out of money, even something as simple as a $55 or $50 put before earnings was less than $1, okay. Weekly put. So imagine if you had this less than $1. I mean, if you were, here's the example that I always use. If you trade a stock, I'm sure you give yourself a stop loss, right? We'll just say $500 as a stop loss. And if a cheap out of the money puts is let's say $1, if you buy 5 of those, that's $500, right? And let's say with that $500, you can easily gain. I think that dollar turned into $10, right? So 10 times your return. If it doesn't go in your favor, well, basically you lost that 500, which you would have lost in a bad trade anyway if you got stopped out. So you see what I'm saying? Sometimes it's okay, and I think it's worth the risk, given, of course, there's a valid setup and a valid trend that to play these earnings, I would only do it to play these earnings on let's say with options. Okay, and you have a valid, let's say you have a defined risk of, okay, I'm only going to buy $1,000 worth of puts or calls, or $10,000 worth of puts and calls, whatever the case is. Okay, so sometimes I want to set aside a small amount of money that I would trade. I guess you can say just these lottery tickets where, hey, if you lose, you're losing small, but if you do make it, you're going to make it big, right? That's where trading becomes a good trade-off, because the risk and reward is there. All right, it makes sense to go into these type of earnings plays, and I will only do it for stocks that have, for example, weekly options, because they are cheaper. I definitely don't want to buy a monthly option unless it's like the week of expiration, and on stocks that are capable of making big gaps like GMCR or Apple or Google or these type of stocks. But since earnings is over, you got to wait for the next 3 months before you can play that again. Do we have any other questions out there for the time being? Let me see here. Chris, why don't you go over, what did you want to go over as far as a watch list is concerned?
Actually, we were using a great example when we were taking a look at some of our sectors that we previously looked at.
Oh yeah.
For an example, if we went back to let's see, XLK.
Okay.
Okay, we took a look at XLK, and it looks pretty good to the upside. And it looks like it wants to get above its highs around 26.75. Now, when I see that, and I look at and I have my watch list, and I want to plan out what's going on next week, well, we always take a look at the sector, or the stocks in that sector in XLK. So, for an example, there's like Apple, for instance. And are we biased to the upside or the downside on XLK? Well, we're actually biased to the upside. So Apple, really, we already want to go. We're already kind of short in this stock. So you take a look at it, and okay, the only filter I can come up with is I'm biased to the upside on XLK, and Apple doesn't look like it's ready to be bought. And plus, we're already sold, so we already have a defined plan of how we want to be with Apple. So then we move on to like the next stock, and the next stock was like IBM. And IBM, we liked it to the upside, and we were saying if XLK gets more buying into it, then IBM's probably going to move up. So what I would do for next week is probably put IBM on my watch list to the upside, and then that's why I keep it. So Apple, it's already on the short side. Don't want to do anything long in that. IBM looks ready to go to the upside. I want to put that on my watch list next week. Now, another stock in this sector is something like Microsoft, MSFT. And Microsoft, is there really a type of trend going on in Microsoft right now? No. Does it look like it wants to break to the upside or the downside? Not really. And, for my taste, it doesn't even trade that much high in dollars or anything like that. So Microsoft is something that I look and I don't really see anything on it, so I won't be watching it next week. So we had Apple short side already. I got a plan for that. IBM upside. I got a plan for that. I'll be watching that. Microsoft in this sector, is it doing anything? No. So I take that off. I'm not going to look at that next week. And then like the next stock is something like Oracle, ORCL. And Oracle, yeah, it does look like it's going to trend up, but right now, to be honest, this is where my pattern recognition comes in, and it looks like a potential double top, you could say. But the most important thing is that it's under that 34 level, which is resistance right now. So I would say, yeah, Oracle looks good. It looks like it's going to move up to the upside if it gets above 34. But you compare Oracle to like IBM, which we were leaning towards the upside. And which one would you rather choose, Oracle or IBM? And IBM, it looks like it's the much stronger stock and it wants to move up higher. So we go back to Oracle, and then we just say, you know what? It doesn't look that good. We're gonna take it off, and we're not gonna look at it for the rest of the week. So we already have Oracle, not gonna look at. Microsoft, we're not gonna look at. And the only stocks that we're taking a look at from the sector right now is Apple and IBM. and then we go to the next stock. You know, we can like something for example like VZ, Verizon. And Verizon, it does look like it wants to move up higher, especially if it gets above that $37 or 75, but there's resistance right at 38. So Verizon's at a potential resistance level right now, and all I would really be saying is, you know, if this stock makes a move above that resistance level, I might consider buying, but because IBM still looks stronger, I probably wouldn't be too aggressive in taking VZ. And that's all I see from the chart, because I'm a big believer in trading what I see and not really what I think. So I see the chart in VZ, it's right under resistance, it might want to make a potential move up, and that's something I'll probably keep on my watch list, but that's something I probably wouldn't be taking a look at on Monday and Tuesday. This is something I'll probably be taking a look at Wednesday or later on in the week to see if this thing does make a break to the upside. So as we're going through each of the stocks in the sector, I'm having which stock that I like to the upside, which stock I think to the downside, which stock I'm going to look at on Monday and Tuesday, and which ones I'm probably going to look at Wednesday or later on in the week. And then there's all those other stocks that I have threw away that we just previously talked about. And I just use this sector as an example, but me personally, I do this with a ton of stocks on my watch list, and it does take me a while to do it on the weekend. I go through about 400 stocks. And a lot of people say, "Oh, that's a lot," and things like that. But if you look how I just took a look at VZ right now, it took me maybe about 10 seconds to really analyze it, and that's what I really do through those stocks. It's just maybe take 5 or 6 seconds to look at it. Is there a pattern? Does it look decent? Am I going to look at it on Monday, later on in the week, or am I going to throw it away? And I cycle through that, and I love to do it on the weekend because it reduces a lot of the workload for later on in the week. And you know, during the week it's trading, we have a lot of work to do already. So we always want to try to lessen our workload, especially if the markets aren't doing anything on the weekends. I believe we have some questions from our members.
Yeah, let's do them. Is the afternoon session for members only? I think you're talking about the stock market recap on Tuesdays and Thursdays, and yes, those are for members only. And what we do is it's like about a 10 to 15 minute recap of the stock market, what we plan to do for the following day. And I think it's a great video because we basically talk about what happened with the market and some stocks that we're looking at, so that way you're prepared for the market the following day, and as well as we do updates on the active trade alerts that we issue on for our members. So that is for members only. But you know, if you're not a member yet, you can definitely get a 30-day free trial. Just email me and I'll give you a 30-day access, and you can just check out the website right there. Today's PM exercise. You know, I don't think we have a PM exercise today. Maybe it's for something else, but I don't think we have an exercise for the afternoon. What platform are we using for this webinar? It's GoToWebinar. Okay, so if you want to check out gotowebinar.com, I guess you want to put on your own webinar, go for it by all means. If you put on your own webinar, I'll attend. All right, just let me know.
I believe he was asking maybe the chart, what we're using for the webinar. So it might be the Thinkorswim charts that we have up too.
Oh, okay. I read that wrong then. Yeah, it is the Thinkorswim charts, and what you can do is use Thinkorswim, sign up for Thinkorswim, which is a broker, and just use their charts. Okay, just go to Thinkorswim.com and sign up as I guess just open an account with them. I don't think you have to put any money in there, but just open an account and you get free access to their charts. Okay, as far as Amazon, you know, Amazon. What's interesting about Amazon is that it's almost displaying the same type of pattern as it did with Apple, and what I mean by that is it's doing a lot of these erratic up and down movements, especially near the highs here. Okay, so a lot of ups and a lot of downs, and Apple is showing that it's starting to crack right there. Amazon, same type of deal where it's showing a lot of these up and down movements. Okay, almost a, you can say like a double top right there. Okay, nice little M looking pattern. It is staying underneath this 220 level. So that's why I meant that if you wanted to take a short position on Amazon, I would probably put a stop above 220 first, because once it gets above that, then it can easily come back to this gap. But overall, Amazon, I think, is showing something similar to Apple, where it could be showing, like I said, signs of a top. And this is where it helps, like looking at the weekly view, where when it was trending up nicely, it was nice and smooth, but you notice like recently it's just a lot choppy. And choppiness is usually not a good sign, especially in an established trend, right? When it's a nice uptrend, it's pretty smooth. But when it starts to get kind of choppy like this, that usually means that there's a lot of, I guess, buying and selling going on. People that want to leave the stock are trying to leave. So that could be very telling as far as Amazon. But overall, I think if it doesn't break this 50-week moving average, then I would still consider it an uptrend. So the main thing is breaking this 50-week moving average, because the last time it came back, it held. Last time it kind of came back and held. Dipped a little bit, but I would still consider this as holding above the 50-week. So until it has a very nice decisive break of this 50-week, then we can say, yeah, then there's that change in trend for Amazon. Okay, and I always rely on the 50-week, right? Every time when a certain stock breaks that 50-week, just like GMCR, just like Netflix, where once it breaks, it's going to break pretty hard, especially if there's news or fundamental reasons of why it breaks. But I always reference back to Netflix, how looking at the weekly view, as long as it stayed above the 20-week, it was good. But once it broke it, then you can kind of tell there was trouble coming towards Netflix's way. Any comments on why I prefer the profit? No preference. I guess it's just something that I've been using since the day I started trading, over 10 years ago. So I guess you can say it's more of a habit, right, than anything else. Are there better charts out there? I'm sure there are. I'm sure there's better charting systems out there. But for me, I don't really rely on any fancy indicators, right? My main indicators are price and volume and some moving averages, and that's basically it. So does profit chart provide these fancy indicators? Probably not. I mean, they have your simple, your more basic, for example, indicators, right? I mean, there's a bunch of them, right? But I mean, am I going to use every single one? Not at all, right? Not at all. So that's why you want to pick certain indicators that you think you're going to use and just stick to them. And for me, my main indicator, like I mentioned, is just price and volume, and I think there's nothing better than just looking at pure, simple price volume action, and that's why I just stick to them. Yes, that is the 50 and 20 week moving average, because the weekly gives you a better trend. Okay, the weekly view always gives you the trend of a stock, or at least the long-term trend of a stock. Okay, the daily views kind of gives you the ups and downs. But whenever I look at the trend, something like Apple here, whenever I look at the trend, yeah, it's making nice trends. It's staying higher highs, higher lows. So the overall bias is still up on Apple, but like I said, right, it's starting to get very choppy near the top. So I would stay away from or showing signs of a top, right? Looking at McDonald's, looking at the weekly view, weekly meaning that each bar, each of these candlestick is 1 week's worth. So it kind of smooths things out. Okay, so that's really what a longer time frame does. When you look at a longer time frame, like a monthly or weekly, it just kind of condenses the information and just kind of smooths out the charts and the trend a little bit. So it makes it easy to see that, okay, this is definitely a nice established uptrend. That's why we went long on McDonald's, because of the weekly trend says it's going higher. All right, and that's why stocks like these I would much prefer. If you were to compare to something like BAC, if you look at the weekly, I mean, even if you look at the daily, it's still a pretty nasty chart. But looking at the weekly, there's really nothing about BAC that I want to be buying, and instead I actually want to be shorting BAC. Okay, so there's a difference there. When you look at the weekly, you can tell the overall trend. But speaking of BAC, I know it's a crowd favorite. It's coming back towards this $6 range again. Okay, so I think the $6 range is very critical for Bank of America, because it held once. here, okay, 2 times, 3 times, and now 4 times. It broke here, but it quickly retreated back up, so I can consider that a fake breakdown. But if it decides to break one more time, I think it can easily go down to $5 once again. Okay, so watch out for BAC if you decide to hold, and don't think that just because it's $6, it's cheap enough. I'm sure you guys seen BAC at a cheaper price. And again, don't buy a stock just because it's cheap. All right, we're not shopping here. We're actually trying to make money. So so stocks like this is a much different stock than compared to McDonald's, right? The trend is different. The personality is different. So when it comes to shorting, yeah, this is a good one. When it comes to buying, McDonald's is a good one, all right? Or other stocks that we mentioned, like TSCO, Visa, those stocks are good for long side. Whereas stocks that are breaking down or already have broken down, I mean, they can continue to break down even more, okay? So never underestimate the downtrend. Just because the stock has broken down already doesn't mean that it can't break down even more, right? Just like First Solar, it's a stock that's already broken down, but it looks like it's ready to break down even more. There's a nice little triangle here that's telling me that it could potentially break down. So it's a shortable stock, okay? So it's a shortable stock. The reason why I say never underestimate a downtrend is, here's a good example of back in 2009, right? Something like Dry's, where it's a $100 stock, now it's a $2 stock, okay? So again, right, never underestimate the downtrend. When things start falling, it can start falling hard. Same with LVS, right? When it was up 150, it fell all the way to, heck, close to 0. Okay, so even though there are stocks that look like, yeah, it's been down a lot, like First Solar, it can continue lower. But of course, it doesn't mean that it will always be smooth sailing. But nonetheless, these are stocks that, if you look at the weekly, it's trending lower. So these are stocks that I would definitely pay attention to if the market does decide to turn around, and they make for greater short candidates. So we basically have a minute left. I don't know if you guys have any more questions or any other things you guys want to talk about. But in the time being, like I said, always come visit our meetup. We're going to probably have another webinar in December. Since it's like holiday time, we usually don't tend to have a physical one. So we'll have another one in December sometime, another webinar, and then we'll open up some more physical ones next year. And of course, come join us on Facebook. This is where you can get our stock market analysis on the weekends and some trade alerts that we post up. And of course, come visit us for a 30-day free trial on our website if you haven't done so already. But as far as our meetup, give us some comments. We'd love to hear your feedback. Give us a good rating if you think this is this type of webinar has good value for you. So overall feedback for us helps you in the long run, because we're basically doing this for you guys. Okay, if there's nothing else, then we can just end it right here. It's right on the dot, 11 o'clock. So that's it. You guys enjoy the rest of your day. Enjoy the rest of your weekend. And thank you guys for coming.